In 2025, the stock market recorded over 50 all-time highs in a single year. That happened while inflation squeezed household budgets, while conflicts disrupted global trade, and while consumer confidence sat near multi-year lows. This isn't a contradiction. It's a system and it can be explained. Chapter 1. The stock market is not the economy. The most common assumption is that stock prices reflect the health of ordinary life. Good economy, stocks rise. Bad economy, stocks fall. This model is intuitive but incomplete. The S&P 500 is not evenly distributed. A small number of dominant companies account for a disproportionate share of the index's total value. When that index sets a record, the underlying cause is often concentrated corporate earnings, not broad prosperity. Wages can stagnate, rent can climb, the index can still post new highs. Skip this chapter and every following explanation falls apart. Chapter 2. Relief, not optimism. Markets frequently rise not because outcomes are good, but because they are less severe than anticipated. If investors price in a worst-case scenario, an oil shock, a trade collapse, even modest positive developments can trigger significant rallies. This is a psychological mechanism, not an economic one, and it explains why markets can jump on incrementally better headlines during otherwise turbulent periods. Chapter 3. The cost of capital. Interest rates determine how attractive it is to hold cash versus other assets. When central banks lower rates, holding cash becomes less appealing relative to stocks, property, and commodities. This was the primary driver after 2008 and during the pandemic response. However, current rates are notably higher than during those periods. This means the low-rate explanation on its own is no longer sufficient to account for present market behavior. A more complete explanation requires examining where money is actually flowing. Chapter 4. Deficit spending and asset concentration. During periods of crisis, governments increase spending significantly. Distribution of that spending matters. When funds reach individuals with limited savings, they are typically spent immediately on essentials. When funds reach already asset-rich individuals or institutions, they are typically reinvested into stocks, real estate, and companies. This asymmetry compounds over time. Rising asset prices are not, by themselves, evidence of broad economic health. In many cases, they are evidence of capital concentration. Chapter 5. Currency confidence. Persistent government debt, currently near $39 trillion in the United States, alongside continual monetary expansion, has measurably eroded confidence in holding cash as a long-term store of value. Investors increasingly reallocate toward equities, real estate, gold, and digital assets as alternatives, reinforcing upward pressure on asset prices independent of underlying economic conditions. Chapter 6. Mechanical amplification. Modern markets are heavily influenced by algorithmic trading systems that respond to price momentum rather than macroeconomic narrative. When prices cross certain technical thresholds, these systems can shift rapidly from selling to buying, compounding upward moves. Options market activity adds a further amplifying layer. When traders purchase call options en masse, the institutions selling those contracts often hedge by buying the underlying shares, generating additional buying pressure. Synthesis. Taken together, these 6 mechanisms: index concentration, relief-driven rallies, the changing role of interest rates, asymmetric deficit spending, eroding currency confidence, and mechanical trading amplification, provide a coherent, evidence-based explanation for record stock prices during a period of broad economic distress. The uncomfortable conclusion is this: rising markets, under these conditions, function less as a signal of shared prosperity and more as a measurable indicator of accelerating wealth concentration. Understanding this system doesn't just explain the headlines, it changes how the headlines should be read going forward.